You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello and welcome to Options Playbook Radio. My name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of the Options Playbook. I'm excited to get into this week's call, mainly because I have a neat adjustment that I want to propose on last week's trade on oil. We used the ETF that tracks oil, or one of the ETFs that tracks oil. That symbol is the USO, United States Oil Fund ETF. And we're going to look at adjusting that trade because it's been a very interesting trade. I talked a little bit about last week about how hard it is to try to pick stocks in this marketplace. It's getting easier. We got through September bumpily, and we are in October. The volatility has continued, and we're still not out of the water. And it's going to be a bit before we can feel real comfortable or feel like we're getting back to our bullish tendencies in the marketplace. The marketplace is still leaning bearish, without a doubt. Fed is still raising interest rates. They will be having a Fed meeting here soon. It's highly anticipated that they will increase the Fed funds rate by 75 basis points. The market is, at least that's what the market is expecting. CPI inflationary numbers are not good so far. We did see housing kind of roll over. So maybe, just maybe, we might see a little bit better numbers the next time around. But right now, everything is a little nerve-wracking, and the VIX index is actually showing us that. And I talked many times on Options Playbook Radio in the month of August about the fact that the VIX just was not displaying the fear that the marketplace should be seeing. And we finally see the VIX still up north of 30. We've seen a few days where we've actually had up markets and the VIX continued to go up. That has happened. So the VIX is now acting VIXly, I would say, and adding the fear that really should be in the marketplace. So with that said, because I really couldn't find an underlying to try to be bullish on, and we had been so bearish on the NASDAQ with a lot of our bear put spreads, bottom fishing in some semis we were looking at, everything about Options Playbook Radio has to do with market conditions. We are using the pricing and the conditions of the option to try to pick a strategy out of the Options Playbook that might apply to this specific underlying or this specific marketplace. So with that said, This is not a profile for just an individual or one-off trade for investors. It's to try to learn, and I want to emphasize that these aren't meant to be recommendations. Okay, so I'm excited because we are taping Options Playbook Radio. It is Thursday, October 20th. The markets are rocking and rolling. On the USO trade, the market went against it and is now flying back to basically where we started when we did the trade. So that's not often when we do a situation with Options Playbook Radio, because we don't choose when we're going to tape it, right? Well, I guess we do decide on a specific time, but we don't necessarily know what's going to be going on in the marketplace. So it's easy to talk about trades that are winning. If you do a trade and you're winning, you just close the position and you get out, and then you move on to the next trade. But it makes it a more interesting Options Playbook Radio when you're using real data, real numbers, real time, and the market is at a point where you would consider adjusting the trade. And that is what's going on today. So let me get into last week's trade. A little bit bullish on oil, just because we didn't know what else to be bullish on. We went out a little further in time, went out to the October 28th expiration. And this is definitely a speculative trade that we put together because we used out-of-the-money option contracts. And if I'm using out-of-the-money option contracts on a volatile underlying like the USO, I am almost always going to spread that position off, only because the volatility means that there's pumped up premium in the option contracts. And that's what we did. So the market was at 71.69 on the day that we put together the paper trade, October 13th. And we bought a 72 strike call and sold a 75 strike call. And what that trade created was a bull call spread, a long call spread, a vertical spread with calls, debit spread with calls. Those are all the names of that trade. We were able to get this bull call spread done for a net debit of $120 to the account, $120 plus commission for every 1-by-1 spread that we did. October 28th expiration, buying a just out of the money call, the 72 strike, going further out of the money and selling the 75. Now, our upside was a little bit bigger than our downside. Our downside is what we paid for it, $120. Our upside then would be $1.80. Hence, you add those together, you're going to get to $3. The maximum spread can trade for is the width between the strikes, which is $3 here. So, $120 plus commission was our maximum loss. Our maximum upside was $180 less commission. Right. So market went down. As a matter of fact, on Tuesday, we saw the market down substantial in oil, and that which obviously dragged down the USO, which is based off of oil futures. You know, whenever we talk about oil, most things that get quoted are going to be the futures price or a barrel of oil. There's a few different entities that you can look at, but that's usually what is quoted. And in this instance, we saw the market run down to around the 68 level. So the trade wasn't looking very good. We did manage our risk by doing a spread. We had limited and known downside. And there was a chance that you might just get out because you had lost half the value of your spread, paid $120 for it. It was trading for south of 60 cents on that day. So a lot of people would say I'm down 50%. I may just get out. Well, the stock did a complete head fake and is now trading as we tape Options Playbook Radio. Now, remember, these are live markets. I'm going to take a snapshot of this one moment in time. And we see the last trade is 71.58, almost exactly where we started this trade. When we started the trade, it was 71.69. It's now 71.58. We paid approximately $1.20, which the markets were moving, and that would have been a midpoint fill. We now see this trading for $1.01 at the midpoint. I'm going to call it $1. So we're down 20 cents on the trade, but we've lost a lot of time. October 28th is right around the corner. That means we got 8 days, well, not 8 market days, but 8 calendar days until these option contracts would expire. Okay, so this is definitely a time when I would consider adjusting this trade. I am a little bit in the money, I'm just out of the money, right where we started the trade. The trade hasn't worked out. We didn't get that bounce up in the shorter term towards the 75 level, but we got a chance to redo it, right? So an interesting alternative, well, you could just stay the course. You still got till October 28th, and maybe the market didn't really understand why it should have went up last week. And I say that jokingly. But now that we have a redo chance, I would consider rolling into a long call spread. Right now, I'm just out of the money. I've had the time premium. I had a little bit of a shakeout, got a little bit nervous. I don't want to take the trade off because I still want to stay bullish on oil. But now, instead of looking to try to make the maximum on the trade, I just would like to get out at a minimal profit. So what I'm going to do now is I'm going to roll this in. I have this position in my account. I'm long the 72 strike call. I'm short the 75 strike call. I'm going to roll this into a long call butterfly spread. And I guess roll is not really the right answer. I'm going to adjust the trade to make this a long call butterfly spread. All right, it's a lot to say. Those are a lot of words to try to put together before noon on a Thursday, which is the day before Friday, which is the day before the weekend. So here we go. I am long the October 28th 72 strike call. I am short the October 28th 75 strike call. I am going to go in with the market rocking and rolling, and I'm going to sell another 75 strike call with that same expiration, go 3 points out, equidistant out of the money, and buy a 78 strike call. I can do that right now. The midpoint is 42 cents for a 42-cent net credit to the account. I started this trade. We looked at doing the trade for $1.20. If we bring in 40 cents, that means that our total cost of the trade will be around 80 cents. Now I'm rounding off a little bit here. So I'm going to take a 30% chunk out of my risk and, a little bit more than 30%, but approximately. And I'm still going to have a chip in a chair. I'm still going to be in this position, and I'm still bullish on USO. I still want the stock to go to 75. Now, the issue with the butterfly is I don't want it to go beyond 75. I want it to finish somewhere close to 75. We have till October 28th. We have 8 days remaining before the expiration of these option contracts. And because of that, we've turned this into a more theta sensitive trade. We're just out of the money. If it stays right where it's at right now, we're going to lose 80 cents as opposed to $1.20. And at this point now, I'm just playing, honestly, the hope game. I'm just hoping that the USO goes above 72 and lands somewhere between 72 and 75. That would be great. Or we could go a little bit higher. We can go a little bit more out of it. It could land at 76, 77, and I'd still be profitable on this trade overall. All right. So once I do that, once I execute that trade and hopefully get it done for a net credit, we'll save 40 cents. Right now it's showing that I could get a little bit more, but we'll save 40 cents. If I get that done for a net credit of 40 cents, I would then end up with long 1 October 28th 72 strike calls, short 2 October 28th 75 strike calls, and long 1 October 28th 78 strike calls. That would be my position. That would be a long call butterfly, and I would have effectively removed 40 cents of risk out of the trade. My max risk then for the new position, the 1x2x1 butterfly, would be 80 cents plus all the commissions that I had to do to get the trade on. My max upside is still, it's actually a little bit higher, but it's got to stop right at 75, right at expiration to get the max upside. And that's the biggest headache of rolling this into a butterfly, is that you do need a lot of time decay to happen in order to get anywhere close to the maximum. So if I did put this trade on and I could sell the butterfly and say get out at 50 or 60 cents profit, I'm okay with that, right? I'm not. This is no longer meant to be a home run trade. By doing any hedge or any adjustment, your goal is, I don't want the cheese anymore. Just let me out of the trap. That's the way that I'm always going to approach it when I'm adjusting a trade. And then I'll get people say, hey, Brian, will you adjust it again? The answer is no. I'm not doing it. I very rarely, on almost any option strategy, and I know some people do way, way long-term out of the money iron condors, but and most of the trades that, especially that we talk about here on Options Playbook Radio, we don't go out way longer in time, and I very rarely will adjust it more than once. Very rarely. Not taking it off the table, but very rarely. Okay. And with that said, now we're going to do a longer term trade. So it's earnings season. We had Netflix come out with earnings this week. We're going to have FANG stocks next week, the bulk of them. So the mega cap, NASDAQ is coming. Interesting, just real interesting quarter for earnings, considering what's going on with the Fed, with the markets, with the VIX. So next week we'll come back and we'll probably look at an earnings trade. One of the favorites is Amazon, because they always announce earnings on a Thursday after the close. It means you got one day for the Friday expiration option contracts to live. But this week, I'm just going to be conservative. AT&T came out, and they're doing really well today. They had a solid earnings report, and I'll let you determine if it was good enough or bad enough. As always, not meant to be a recommendation here. But right now, I see AT&T run. Once again, the markets are rocking and rolling. It's Thursday. And AT&T is up $1.43 on a $16.97 stock. So we'll just round that up tonight to a $17 stock. And I'm bringing this trade up because if you do have capital on the sidelines, a stock like AT&T is interesting to look at a FOMO trade, which I haven't talked about in a while, fear of missing out, where you're still nervous about the marketplace, but you wouldn't mind allocating some capital elsewhere. Did AT&T eventually hit the bottom? I mean, it's a $16 stock. Who knows, right? I mean, you are a little bit trying to catch a falling knife, even though the market is up strong today. The thing that I like about the strategy that I'm going to talk about today is the conditions of AT&T after the earnings announcement. And what I mean is where the implied volatility is at. We're going to go out longer term, what the bid-ask spreads are at. There's a lot of volume going into AT&T today. And it makes it enticing that if you wanted to buy AT&T, it's a low price stock. It's fairly easy to buy 100 shares of it. If it's at 17, you're talking about $1,700. But let's actually lower our risk, because if we go out further in time and still want to be bullish on AT&T, we can get a decent market in the long-term options. And here's the thing about buying longer term options as a surrogate for the stock or as a stock substitute. Almost everybody would do that as an alternative to buying the stock, where you had managed risk. You still get a lot of stock price representation because we go deeper in the money. But the issue is that the markets are way wider usually in the longer term options on any particular stock. And it makes it hard to get in and sometimes get out of the position. So that's always a concern on deeper money, in the money options. If not, I honestly, well, except for maybe in my 401k, would just, why not just buy longer term option contracts all the time, manage your risk, and maybe every once in a while sell a call against it, and hence you have a fig leaf. We're not going to do the fig leaf today because, bluntly, there's not enough juice. There's not enough premium in the option contracts to make it that attractive, mainly because they just announced earnings and vol has already came off. You got a big, strong move to the upside. The known event has already happened. So implied volatilities are low. So I'm going to go out to the June 16 call option. And if I'm looking at the most at the money, like I said, we're going to say the stock's out at 17. It's just a few cents away from that. That option contract is trading at a 22% implied volatility. And the market right now is 145 by 50. Now, obviously, AT&T stock is only 1 cent wide, but we're 5 cent wide on this longer term option for that at the money option contract. But now we want a stock that's going to act a little bit like the stock price, right? Or I'm sorry, act a little bit like owning 100 shares of stock. So that means we need to go deeper into money. We need to get a better delta in that instance. So if I go down to the 15 strike call option, just a couple of points away, I see my delta at 83 right now, 0.83, or for every dollar that the option moves, our price of our option contract should increase by approximately 83 cents. All right, not bad. I can get a decent delta going a little bit in the money. And instead of having the risk of $17 or 17 points, because the stock can't go below zero, I'm going to be able to buy this option contract. I see the market at 268 by 275. Open interest is 3,111. We got a few contracts that have traded today, 35.36. So this is an interesting alternative if you were bottom fishing in AT&T after a solid earnings report and solid forecast for AT&T from their CEO, who was on CNBC this morning. Okay. 268 by 278, it's still a dime on a percentage basis. It's still fairly big. But even looking at the 14, 13 strike, we're still looking at about a dime wide. So not bad markets on longer dated option contracts. It makes it enticing to buy those as an alternative to buying the stock outright, get a lot of stock representation. So this week's paper trade, I guess we'll just pay the ask, which is 278. I would probably work it a little, let's say 275. Let's see, let's assume we can get 3 cents off the ask. You can never guarantee a non-marketplace fill, so on a limit order, but here's where we're going to say. So we're looking to buy the June 16th, 2023 call option, 15 strike, 239 days away. Market right now is 268 by 278. We're going to try to buy this at 275, which is $275 plus commission as a max risk. We have a delta of 83, which means that if the stock goes up 1, you would expect this option contract to go up approximately 83 cents. So you get a lot of stock price representation. Our maximum risk will be the net debit paid of $2.75. And we have unlimited upside potential on the way up, all the way out until that expiration date. So the timing's right to kind of consider some of these longer term options. And I like to do it after earnings. You get a little bit higher volume. Sometimes you have tighter markets. Implied volatilities usually come off. And that's when I want to consider doing leap options or longer term options. This isn't a leap. It's only 239 days out. Leaps are usually 9 months or longer. And leap is just a fancy name, long-term equity anticipation security. Just means longer dated options. Chicago Board Option Exchange came up with that marketing term. But with that said, that's it for this episode of Options Playbook Radio. If you have any questions you'd like to answer me, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for coming. We will see you same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.